This is Las Vegas Real Estate Now, where we bring you the 3 E's: educate, empower, and engage. I'm your host, Harvey Blankfeld, and we've been selling homes here in Southern Nevada since 1988. We're also very proud to be part of the Real Estate Radio Network. That is a national network of local real estate professionals delivering timely, balanced truths about local market conditions. And with us in studio right now, we have John Ingram from Cross Country Mortgage, NMLS number 552596. He's been doing this lending stuff here locally for the last 15 years. I wanted to talk about VA loans because there's perceptions out there, and then there's the realities of this thing. And I want to talk a little bit about this.
Yeah.
The quote unquote non-allowables. Let's talk about those a little bit. And first of all, what are they?
Okay, so unlike most other mortgages, the VA has specific rules where they've said we don't want our veterans paying certain expenses that are typical in transactions. One of which being commissions for real estate.
In the past, the assumption was, and often implemented, that the seller has to pay these, because if the buyer can't, the only one who can pay it is the seller.
Yeah, this is something that I get into on an educational basis quite a bit. So I teach classes to realtors and this sort of thing.
Yep.
And as part of that, one of the big pushes that I'm trying to get across to change this is to sort of reverse or unlearn some of the old school mentality.
Yes.
The perception does exist in the marketplace that if I'm a seller and I accept a VA offer, I have to do something. I have to pay those things that the veteran is not allowed to do.
Right.
Basically what it says, or at least under my interpretation and everything my research has led to, is the VA will allow the veteran to pay those sort of non-allowable expenses up to 1%. I believe that the lender has to, if they choose to, they have to disclose what they're charging to the consumer, i.e. this 1% fee.
Right.
And then they can spend that money to pay the things the veteran is not allowed to pay.
Gotcha.
But if the lender does not disclose that fee in advance, then they can't just add it as you're going through the process.
Okay.
Under the approach of traditional mortgages, they really heavily scrutinize your debt ratio, and they've come up with a standard percentage, right? So under these loans, in general, they want you to have less than half your income going out for bills, right? So under this scenario, if I use an example, let's say I make $1 million a month. I'm heavy hitter here.
Wow.
And I have $500,000 a month of bills. A normal mortgage is going to say no to me because I have a 50% debt ratio.
Right.
Exactly right. They're going to say no to me.
But you're clearing $500,000 a month.
Right. Exactly right. So the VA actually looks at that a little differently. They say, well, under that example, you've got $500,000 a month left over. We think you can afford this $3,000 house payment that you want.
There you go.
They're focused on the dollars left over at the end of the day.
That is smart.
More so than some arbitrary percentage. In traditional mortgages, we ignore what it costs to, say, take care of your house, utilities and things like that.
Right.
They ignore how much you're paying in taxes. The VA doesn't. The VA looks at your net dollars after paying taxes. The VA kind of has come up with numbers for how much a house will cost you to maintain.
Right.
And makes you qualify with those things in mind, focused on sort of real life. And what does it take to take care of you and your family? So family size is also another thing that they account for.
Brilliant.
A family of 2 takes less money than a family of 5. All these things are looked at in this different approach that the VA uses.
You've been listening to Las Vegas Real Estate Now with host Harvey Blankfeld. Please tune in every Saturday at 11 a.m. right here on News Talk 720 KDWN.